Well, it's my privilege to stand before you again. This time, it is an honor to introduce to you Paul Volcker, a Princeton graduate, I'm proud to say, and once my colleague at Princeton. His office was next door to mine, and from time to time I went to visit him, and he told me that we economists don't know how the real world works. And I told him it didn't matter. I had tenure, and therefore, as a tenured econ prof, I'm licensed to teach students about the real world and how it works, even if I don't. And so we left it at that, but I learned a lot at his feet there. Paul also has very close ties to George Washington University through scholarships and graduate fellowships. We at Princeton think, and I personally think, I cannot imagine anyone who represents better Princeton's motto, which is Princeton in the nation's service and in the service of all nations. We added that later. It used to be Princeton in the nation's service, and then we discovered there are people elsewhere too. Paul worked in the federal government for almost 30 years, in 2 terms as chairman of the Board of Governors of the Federal Reserve System. He navigated the organization and the nation through one of the most turbulent economic periods, and he is widely credited with ending the high level of inflation in the United States during the 70s. Most people here are too young to remember that. I do remember it, 18% interest rates, and so on. He served as Undersecretary of the Treasury for Monetary Affairs and as President of the Federal Reserve Bank of New York. After retiring from the Fed, he was chairman of Wolfenson and Company and retired from there in 1996. Whenever you need a commission chaired by a world-class distinguished person, you go to Paul Volcker. For example, he served as chair of the Independent Committee of Eminent Persons to investigate the dormant accounts of Jewish victims of the Holocaust still sitting in Swiss bank accounts. I remember we actually talked about that. He served as chairman of the board of the trustees of the International Accounting Standards Committee, and he is former chairman of the board of trustees of the Group of 30 and the Trilateral Commission. Now, we learned at lunch from Barney Frank that somebody asked, where does the Volcker rule come from? And he said it came from God, which is true. But it was revealed to us by his prophet, Paul, who came. Now, in 2013, Paul launched the Volcker Alliance to address the challenges of effective execution of policies and to rebuild public trust in government. Unfortunately, it did not work out so well for Obamacare, but I hope execution in the future will be a little better. The Volcker Alliance is a nonpartisan organization, and its mission is to catalyze new thinking and action with respect to federal, state, and local government in the United States. Indeed, he continues to serve in the nation's service. Please join me in welcoming one of America's most distinguished men, Paul Volcker.
Thank you, Uwe, and ladies and gentlemen, you bring back some old memories of Princeton and nation service. I used to take some pride in that thing. Now I used to think I knew what it meant. It's kind of vague, but it sounded good. And Princeton and nation service and everybody's service doesn't mean much to me, I must say. So I wish they hadn't changed all that. But we have memories, and I'm glad to be here. Sorry I couldn't be here earlier because you are on a subject that's close to my heart. The Fed is a bank regulator. I happen to be, speaking of academics, up in Syracuse, where it is snowing rather vigorously this morning. So I'm glad we made it, but the subject of the debate last night at Syracuse was behavioral economics, and said there were human beings involved. I think that's the sum and substance of behavioral economics. But you spent all day talking about the role of the Federal Reserve in financial regulation. And it's interesting that the emphasis was so much on the Federal Reserve. I ran across a recent speech by Alice Rivlin, who may be familiar, all of you. She's been around almost as long as I have been. Has this reputation as a distinguished commentator on the economic scene, very sensible person, really in the nation's service. But she made a great point in this speech that inflation is over. We don't have to worry about that anymore, but there are lots of things to worry about. And what struck me, she listed 4 in particular. Her first thing to worry about, her first challenge, pride of place in her analysis, her number 1 point, now I quote, "The main job of central banks is avoiding financial crises." There it was, not word about the dual mandate, nothing about QE 1, 2, 3, no debate about what patient means or impatient means. It's the Federal Reserve's responsibility for financial stability, and that takes precedent. When I read that, it took me right back 100 years to the foundation of the Federal Reserve. And that followed, and the reason we have a Federal Reserve, of course, was in response to financial crises, and the hope and expectation, not just in the United States and elsewhere, but elsewhere, that central banks would produce more financial stability, and that was basically their job. Now, I tell you, I yield to no one in the strength of my conviction that any responsible central bank, and that certainly includes the Federal Reserve, cannot escape a certain responsibility for financial stability. Concerns about the structure of the financial system, that's what you've been talking about. And so I welcome the fact that this has been on your program all day long. But I also recognize some other realities, and one is that not everybody in the world accepts the conviction that I have and the authors of this program had about the importance of the Federal Reserve's responsibility for financial stability. There has been a time when, not so long ago, when the kind of prevailing view was that markets can take care of themselves and financial markets can take care of themselves, and the less the Federal Reserve or anybody else intervene, the better. And then we have the fact that academic economics, for a long time, a little bit different in Syracuse today, but so-called macroeconomists worried about employment and price stability and the trade-off and maximum employment, stable prices. How do we do it? We'll run 1 million regressions, a lot of very precise equations, very few of which took any account of financial markets, which we have discovered is a lacuna, to say the least. So again, I welcome your focus today on the Federal Reserve, which I take as a point of departure that of all the agencies involved, and there are a lot, that the Federal Reserve is the best equipped, the most independent, and most respected financial agency of the United States government. I have that written down here, and I believe it. But it's also true that that can't be taken for granted, and any of you around this city know that it's not necessarily the unanimous view, and the Federal Reserve, as a matter of practice, is of course not alone in the exercise of supervisory and regulatory responsibilities. But I think the financial crisis has exposed just how rickety and out of date our regulatory and supervisory framework is. So there's a lot of raw material to discuss here. The pattern of inconsistencies, overlaps and gaps, differing priorities, squabbling over turf, competition and laxity, and particularly lack of coherent oversight of financial innovations outside the banking system, the traditional banking system. Had a little discussion of what to call that earlier, called the shadow banking system. All those difficulties have been revealed in all its ugliness. I make a practice of asking people whether the current regulatory financial system makes any sense. I haven't found anybody yet that says yes. Then I ask, what do we do about it? They say impossible. And that's a unanimous view too, and that's about where we stand. We've done a little research in my little new Volcker Alliance as to how many attempts have been made to reform the financial system. There have been more than 20 since World War II, official investigations, either by the Congress, the executive, one or two very extensive private efforts, not one of which has had any particular impact on the actual structure of the system. So we all can share a little frustration, but let me say, maybe it's a sign of adult old age or something, but I don't want to accept the conclusion that's so widely held that you can't do anything about it. And so that's why this new Volcker Assembly, I won't get into that, that's not our main function, but we decided, or I decided anyway, that we ought to get into this particular subject because it's should be ripe for action. And of course, we are not entirely alone. The big, fairly recent comprehensive view of this was done by the Paulson Treasury, and they began laying out rather extensive changes over a period of time. It was all aborted by the fact that before any real progress could be made in the legislative or to settle the various debates, before the legislation, we had a financial crisis. It was all put on the shelf. Much more recently, the Bipartisan Policy Center here in Washington a year or so ago has produced a very thoughtful report, some provocative proposals as to how things should change. And of course, as you were discussing earlier, Dodd-Frank itself did make some changes in this area, although the idea of a whole-scale revamping of the regulatory structure was rejected, I think for good reason. They had a big legislative burden as it was. But we do have a challenge, and I don't want to linger over all the dimensions of that challenge. The relevant point, I know there's different statistics as to how you describe this, but 20 or 30 years ago when I was in the Federal Reserve, when you talked about the banking system, you were talking about 70% or so of the world of finance. Now, if you talk about the financial system, 70% or so is the world of shadow banking, and 30% or so is commercial banking. And all the regulatory structure has been focused on traditional commercial banking, and that doesn't make a lot of sense. And apart from the growth of scattered, tempted to say almost undisciplined, shadow banking, we have the fact that individual institutions have become of enormous size. And you do get a little perspective with age, I guess, but it seems to me just yesterday that we no longer had restrictions on interstate banking. It wasn't very long ago when big banks in some states couldn't have any branches at all. And we have skipped from restrictions on interstate banking only 20 years ago to full-scale banking across the country, banks of enormous size, made even bigger after the crisis. And I think it's demonstrable that, if you want to say modestly, those banks are difficult to manage. I think if you say they're impossible to manage effectively, there's some wisdom in that. They're without question infused with enormous conflicts of interest. And I like to think the principal concern is that we have adopted compensation practices that frankly challenge any practical application of the old-fashioned idea of fiduciary responsibility. The responsibility is how to measure your return in dollars and cents, and that's the way you get paid. And that's in the private sector, but in the public sector, we have a bit of a mess too with overlapping turf, and different agencies want to protect their turf. And we have political turfs that want to be protected in the Congress and elsewhere and among the lobbying community. So we've spent a year or so in the Alliance and tracing the history of failed reforms to see what we could learn as a basis for making recommendations for the future. We've looked at international experience. We've engaged in a considerable consultative process, including with some of the people in this room. And after kind of looking at the entrails for a year or so, I myself at least think we're coming up with some pretty good ideas. Now, I'm not going to talk about all the specifics today. And I also don't claim that we're going to have every single point exactly right. But I think there are some broad approaches that make some sense and ought to be considered in any reform of the system. And my number one point, particularly in the light of your conference here today, is we can't leave banking and financial supervision all to one organization, even to the Federal Reserve. It's not just that that is a huge extra responsibility that you would put back on the Federal Reserve, and they do have a few other responsibilities, but it also, that degree of centralization of economic and indeed inescapably political power doesn't sit very well with our basic political and constitutional traditions. Now, if that's true, so far as the Federal Reserve is concerned, an important role, but not the sole role, what about the Treasury? And that question has been risen more specifically than in the past, I think, because of the changes that were made in Dodd-Frank. And I do think we need to keep the Treasury. I spent part of my life in the Treasury, so I have some feelings about that too. And we ought to keep them involved. They do represent a certain political authority, and they certainly reflect an interest in broad economic policy. And of course, it's evident after the great crisis we have, when you really get in trouble, you got to go talk to the Treasury and get their cooperation and participation, and even look to their leadership. Now, that was put in a formal way in FSOC and the Office of Financial Research, and there's a little unhappiness about how that's been working out in practice, and there are more experts here than I as to that, but people are unhappy with some of the functioning, and I get two kinds of criticism: that the Treasury shouldn't be involved at all, and the other is the Treasury's involved but hasn't got enough authority. It's a little hard to reconcile those two distinct views, but our view, my view, is the Treasury has to be involved at some extent, but it should not be in charge of the process. Then we have the agencies that are in charge in a sense, and their feet are on the ground. And clearly we need a better definition of what their responsibilities are individually or collectively, and dealing with the overlaps and lapses and inconsistencies and all the rest. And we also, consistent with my earlier remarks about the Federal Reserve, I don't think we want just one agency necessarily, although having fewer is certainly to be desired, but there is some record. If you go back and look at history, and two themes come. We ought to unify it all. That's what the Hoover Commission said 75 years ago now, almost. They were reforming the whole of government, put it all together. It wasn't done. And the other side is, no, don't put it all together. It's too strong, too powerful. You've got to have some checks and balances. And I think you have to give some attention, should be given some attention to some dispersion of checks anyway. We also need to worry, and a lot of emphasis has been put on this point by the bipartisan policy study, that you just nuts and bolts, so to speak, of building a strong supervisory staff, making sure it's adequately paid, making sure there is independent financing of these regulatory institutions so that they can be professional and have some continuity and some independence. All of that is really basic to the reforms that we are looking at, and the rest of it is kind of detail, which I will not expose in full detail, but let me give you a little more feeling about the direction in which we are headed. And first of all, I'd say that we're going to have a pretty fat report, but we've decided that there are some questions that we're not going to deal with right now that not exactly subsidiary, but they may bear upon the centrality of the issue a little less. One is the role of small banks. Everybody wants special relief for small banks. That's a dangerous kind of approach because what is small is very interesting. I'm sure when we make special arrangements for small banks, you will have 18 lobbyists the next day visiting their congressman and say, I represent a $200 billion bank, and we are a community bank, and we want all the relief that our little neighbor across the street has. And soon there'll be a $500 billion bank, and so forth and so on. I think Wells Fargo is the biggest small community bank in the country. So it's an issue, but some degree a subsidiary issue. But yeah, I mentioned it because I'm told, and this inevitable, I picture these lobbyists in this town are all termites, constantly eating away at the rickety structure of the financial system. And the particular structure now, they've got another rule. How can we move the Volcker rule, or whatever that is, from really small banks? And I agree with really small banks. What are they doing out there? Proprietary trading and all the rest. But I'm a little suspicious of, I think we take great care before we begin making these things. Let's look at the whole system before we look at these little pieces around the edge. Also recognize that we got a mortgage market now, which is, as you all know, is basically a government-controlled mortgage market. Someday I'd like to see it a privately run mortgage market again, but I'm not going to touch that today or later. It's obviously a big issue filled with political questions. I'm not going to touch the insurance business either. No, it's interesting. I was involved with an insurance company 10 years ago or so in an earlier crisis, and they all decided the big ones would like some federal supervision, so they didn't have to worry about 50 different states. So we've been talking to some of the insurance lobbyists recently, and they've all changed their mind now for whatever reason. They're not interested in federal legislation anymore. But I don't think that's a really central issue. Now, we do know that the Congress is having actually currently at least hearings on some aspects of financial regulatory reform, and maybe that's hopeful, but I'm a little bit worried. They're dealing with peanuts, and most of the peanuts are not very satisfactory anyway, like auditing the Federal Reserve banks or doing something about the Federal Reserve Bank in New York or doing something about other Federal Reserve banks. And whether you follow a definite rule, whether the Taylor rule, rule supreme, or whatever, none of those seem to me very good ideas. And I like to see the Congress involved, but I don't like to see them confined to those incidents. The logic is to have some comprehensive change, not piecemeal change. And a lot of that piecemeal change would, I think, weaken regulation, weaken supervision, rather than the reverse. I recognize political climate is not exactly conducive to any major legislation, but I keep arguing that this is a challenge and a piece of legislation. If it's done well, it's undoubtedly complicated, it's major, but it's not, I don't think, raises the kind of ideological issues that doom it to failure from the start. I think Alan Rivlin is right about the importance of avoiding another large-scale financial crisis. And the way things have been going, and her remarks, just to put this in perspective, kind of repeat the relevance of remarks made 150 years ago by the patron saint of central banking, Walter Bagehot, who made the simple point that money will not manage himself. I don't think he worried about reconciling price stability with full employment, but he did worry about the impact and responsibilities of the central bank in financial markets. Or you might prefer, the old saw, if you don't learn from history, you're going to repeat it. And we have enough history now. And if there's ever an opportunity to do something, it's now, because failures of regulation were not the total responsibility or anything like it for this financial crisis, but there certainly were failures of regulation and supervision that ought to be looked at, and that provides the framework for the kind of direction we'd like to see to go in. And the first is, given the change in the nature of financial markets and the relative lesser importance of commercial banks relative in the aggregate to the rest of the market, which has not had the same degree of supervision, to say the least, point number one is, yes, we do need adequate surveillance and oversight of the so-called shadow banking system, or say the whole financial system, which includes a lot of financial institutions that are growing like topsy outside the traditional banking system. And as I said earlier, that need was recognized in Dodd-Frank by the creation of FSOC and the OFR. When we look at what's happened and we look at the lay of the land, I think FSOCs and OFR are there both because they are, in principle, a logical reaction to what's been going on in the market. That you want, among other things, to get the Treasury involved. You want some vehicle for bringing the agencies together, forcing more coordinating decision-making, and you need somebody responsible for looking over the whole financial system and not just collecting statistics, but making judgments about what to do about it. So we will be recommending what I think of as kind of twisting a little bit the present arrangements. We think maybe the Secretary of the Treasury indeed ought to remain chairman of FSOC, but I don't think it's necessary for him to have a vote. He can have whatever persuasive powers he wants, but he shouldn't be ultimately responsible, because we'll get to agencies that I'll talk about later. And FSOC could have some function for checks and balances against other decisions that might be made by other agencies. Just how that's done with subcommittees, what the vote should be on the FSOC and so forth is all interesting, and we will make some comments about that. In a way, it will be loosened linked to the Treasury, but I think more effective in a consultative role and more effective in oversight than it has in fact been. There will be some appeal role against other decision-making elsewhere in the system. Now, secondly, what do we do about the hands-on regulation and supervision? And we come up with the thought that, yes, supervision ought to be unified, which is not uncommon in the recommendations of many other people through the years, including the bipartisan center, but maybe there's a certain logic in separating supervision from regulation. And when you're talking about regulation, you're talking about the structure of the system. You're talking about how the system as a whole operates and who is responsible for that, or who is in the best position to make those judgments. And I come back to what I said about the Federal Reserve before. So I think that we can divide out the supervisory thing, get rid of the 4 agencies that are already involved in supervision, make it one agency, connected to the Federal Reserve by some means or another. We have ways of doing that, but the regulatory authority would be with the Federal Reserve, subject to review under certain circumstances that we would describe. So you would have a single supervisory authority and an overreaching, overreaching sounds bad, regulatory authority centered basically in the Federal Reserve. Now, just to be clear about that, when you talk about existing supervisory authority, you have the Federal Reserve, you have the OCC, you have the FDIC. If people forget, you also have the SEC and their supervision of so-called broker-dealers. Broker-dealers sound like somebody doing a little stock transactions for you. Well, Morgan Stanley is a broker-dealer, right? But so is J.P. Morgan. So is Chase Manhattan. So is any of the big banks that have a dealing department. And in my mind, one of the major sources of confusion and difficulty in the build-up to the crisis is that the vision of responsibility for the big banks themselves, though the sensitive operations of big banks themselves was an important factor. The SEC is a very important agency, but has not been important in terms of effective supervision of broker-dealers for financial strain. So when I talk about combining supervisory powers, you are taking some authority away from the SEC. On the other hand, the SEC should be built up and doing what it likes to do, and hopefully does well, and restore some of the prestige and force that it once had by assuring adequate financing, by a long-sought combination of CFTC and SEC. And what I say about supervision in the SEC, I could also say about the CFTC. So while we're strengthening the supervision on one side, we want to strengthen investor protection, market integrity concerns of the CFTC and the SEC on the other side. That is a kind of broad outline for a big fat report that I hope will make birth within the next few weeks, if we can find a printer able to handle that many pages. And I recommend it to you for your serious consideration. We don't claim that we know the precise answer to every particular point, but I really do think the time has come that this ought to be debated in a way that gives some hope, given all that's happened in terms of producing a regulatory structure that seems to make more sense. I might say, when I think of Don Cohn here, who sits on this, whatever it's called in the UK, they have a breakdown very much. If you look around the world and you look for some kind of model, it's not exact, they're a parliamentary system, we're quite different, but if you look for a model of the central bank having a very strong position, but it kind of delegates the supervision off with a very strong link to the bank, in that case actually part of the bank. The market conduct, the business conduct is put off separately, also with a link with the bank. And then you have this potentially important board, whatever it's called, that Don Cohn sits on, so he makes it sure it's important, to look at the system broadly and maintain the kind of vision that we see for the Federal Reserve here. So it is very much, when I look around the world, the model that seems most appropriate. Most countries' model is not terribly relevant to us because the markets are so much smaller and less significant internationally. There isn't, I think, a lot of you can draw from their experience. So with that much, I'm supposed to be able to answer all questions, or I can't believe there are any questions, but I
kindly agreed to take questions from the audience. So if you have a question, please put up your hand and wait till the microphone comes to you. We've got one over here.
So you're perhaps best known for your eponymous rule, the Volcker rule, which, in addition to being one of the biggest, most important aspects of Dodd-Frank, is also the one that has created quite an industry for compliance officers and consultancy firms and lobbyists. Is that, having that retrospect, do you think Do you have any thoughts about the amount of money that's being made in consultancies related to compliance with the Volcker Rule? Do you think that you would change it, knowing that? What do you think about that legacy?
So I think
Is he raising a question about the
right,
Volcker Rule?
Volcker Rule, yes. So based upon the experience with the time it took for the agencies to implement it, the amount of lobbying and consulting.
Well, no, it's a classic example of the problem. You're not going to cure all the problems by having fewer agencies, but this is such a clear case of the weaknesses of FSOC, I think, as it's constructed, but more broadly, the weaknesses of the system when you had 3 or 4 different agencies, I guess compelled in this case by law to adopt the same regulation, and it took them 4 years or 5 years to decide upon what the regulation is, and then they're immediately lobbied to the point that delay the effective date another 2 years, another 3 years. They're a perfect example of the way the system is working in Washington. Whatever happens, you've got to have a lobbyist on duty to get whatever little twist you can get, so he justifies his pay from his retainer from the bank. He's got to report to the bank every day what I did for you this month, how many congressmen I visited, how many times I promised him a fundraiser, and yeah, oh, you know, we got this thing pushed off another year. Look what that. It's this lousy system. Particularly with the purity of the concept.
Yes. The rule didn't end up the way you had hoped it would.
Well, pretty much. I think in the end, it's a lot more. You know, this is it's not just the Volcker Rule, it's anything. I used to be involved in accounting. And there was this great debate. The international accountants said we will have we'll rely upon principles. And the American view is, no, we've got to rely upon rules. And it's just whatever, the whole psychology of the country. You have a accounting rule, you can't rely on what the principle is. You want it spelled out exactly in the Gatsby, or not Gatsby, in the FASB rules. And
with 20
just
safe harbors, right?
Yeah, I'm blaming the lobbyists. I'm going to blame the lawyers now. No, one of my favorite experiences, just, God, how much chance do I have to say this? When I became chairman of the Federal Reserve, I had been president of the Federal Reserve Bank in New York. And I kept hearing all these complaints about the truth in lending regulation. That was an important Federal Reserve responsibility. I got, all these things, what's so complicated, blah, blah, blah. So when I went to Washington, I told the staff, look, we're going to redo the truth in lending regulation. I want it down to 100 pages, which tells you it had been more than 200 pages. The staff says, it's impossible, we can't do it in 100 pages. And I said, well, you go do it in 100 pages anyway, try your best. And they took a while, they came up with a 100-page version of Truth in Lending. We put it out for comment. Every comment we got was from bankers making it more complicated. Because you haven't taken care of it precisely the way we want to advertise our interest rate or how we calculate our interest rate. So we had another ruling. I don't know whether we got back to 200 pages or not. But it's just typical of the way things happen here, right?
Maybe a question here.
Yes, Chairman Volcker, my name is Bart Naylor. I work for Public Citizen. I used to be the Chief of Investigations for the Senate Banking Committee when you were the Chair of the Federal Reserve. The Volcker Rule then used to be known as, if we wanted to find you, you would be at the oyster table at any one of these bank conferences. Public Citizen, meanwhile, has submitted more than 30,000 comments in support of the Volcker Rule and for simple separation of banks and proprietary trading. Regarding the culture of Wall Street, New York Fed President Dudley has suggested that senior banker pay at a company such as Goldman Sachs, it would involve maybe 2,000 of the senior executives, would have a sizable portion of their pay deferred, such that if the bank engaged in any violation and had to pay a penalty, it would be that pot that would be used. So Citigroup paid $7 billion in shareholder funds, Bank of America a larger figure and so forth, but that's shareholder funds. Your views on Mr. Dudley's proposal?
Well, I can't comment on a particular proposal, but as I said earlier, I think it is a big problem in the financial world, and maybe in other parts of the world too, with what is considered modern management practice, that you will measure all your activities as best you can in terms of what that means for profitability for the company, and that's the way you're going to get paid. And if that's the incentive you give to the people, you know, there's no real relationship. They all say they love relationships. There's no relationship. There's a counterparty. And of course, the customers act that way too. They no longer rely upon a bank for, you know, we're your old customer and we'll get special deals. The whole thing is going with a kind of bloodless counterparty philosophy, which, you know, it's not the world I grew up in, so you have to discount what I said. But when you know what happens in these big investment banks, it comes time to choose the bonus at the end. They have already put in their computer every transaction that guy has been involved in and what credit he gets for that particular item, what percentage of the profit to the bank goes to his core, to his record, and he goes and visits the boss or his boss at the end of the year, discuss bonuses, they push a button on the computer, and, well, you didn't have a pretty good year last year, Johnny. It's not showing up very well, and the profits you made for the bank, or whatever other thing. I'm exaggerating a bit, but I'm not exaggerating. They keep track of all that on the computer and they look at it at the end of the year.
And the question is, when things go bad 3 or 5 years later, is there any accountability?
That's right. You know, you can think of these schemes to try to ameliorate the impact, but boy, it's hard. Yeah, I mean, I welcome to please come up with these kinds of ideas and see which ones are feasible. And the British, of course, are more aggressive about this than we are. I don't think I have anything to add other than it gets to be a pretty impersonal business, which gives rise to behavior patterns that are not really consistent with what we used to think was fiduciary responsibility.
Another question? Do I see? Yes, we get the microphone right here.
Thank you, Mr. Chairman. My name is Zhao Peng from Johns Hopkins Science. I have a question regarding Volcker rule. In terms of what do you think about adding a third term capturing financial instability in addition to unemployment rate and inflation in that equation? Thank you.
So you would add the concept
third
of
term.
financial instability in what way? How would you use it?
So say, so right now the equation captures both inflation as well as unemployment. But what about adding a third term? I'm thinking about, for example, the total leverage in the entire financial system.
You go back and look at the law and investigate its founders. There's a tri-mandate. It says maximum employment, stable prices, and moderate interest rates. I don't hear about, we got moderate interest rates. That part of the mandate we're over-accomplishing. But,
and I think the originally stated purpose of the Federal Reserve Act of 1913 was to ensure financial stability.
Well, yeah, it wasn't quite worded that way, but to provide a more effective system of commercial banking, I think is what it said.
Right.
But what they meant was, yeah, let's not have these banking crises all the time. Now, you know, when Alice Rivlin said, number one responsibility is to avoid a financial crisis. You know, in part, you have to say good luck. Let's moderate it a bit. There are things in the I had an interesting discussion at Syracuse last night where they had one of the world's leading behavioral economists speaking. But, you know, the burden of his story was, you know, you dealing with human beings who react today to what happened yesterday, and things accumulate in a way.
Spirits,
animal,
right? Yeah.
It's not just spirits. the housing thing, you expect an increase in housing price, you buy a house, and in fact, the house price goes up, and then you buy even more, and that is the nature of financial markets. So all we can do is our best to try to keep them in bounds. I thought this other question maybe, I would have said if I was up here, I did say, I said what it is in the Federal Reserve. If we can manage the stability of the banking system, we don't have to care about the rest of it, because it's a smaller part of the market. If they go bust, the world isn't going to come to an end. But you can't say that anymore. These institutions have gotten too big, too difficult, too many essentially banking operations, banking mediation going on, too much maturity and credit transformation. It used to be that's the heart and soul of banking is going on outside the banking system.
Deposit substitutes of all
all securities lending can finance a big bubble in the markets. Repurchase agreements. Repurchase agreements are as old as the hills, but not the way they're being used today. And it builds on itself. And
we know your views on money market funds.
Well, money market fund. Well, that's straight. Regulatory arbitrage and escape, where you have these institutions that they like to sell themselves as banks, but they're not regulated like banks. And they're mutual funds. They don't want to be regulated like mutual funds either. So, and it's been a real strain of weakness. Of course, this was evident in the somebody mentioned that, I think, when I was here before. I don't recall having seen an area in banking regulation where different agencies were as in much accord with the administration, with the Federal Reserve, with the other agencies on the need to do something, but action did not ensue anyway until a half action finally ensued. And that in itself is an illustration of something that needs to be repaired.
Your proposals try to perhaps attempt to give FSOC somewhat more authority to break the tie or break the jam in that situation?
I don't want to get into all the fine detail, but we would give the principal regulatory authority, regulatory initiative, to the Federal Reserve, and they would exercise surveillance over the whole. They don't need any new law to exercise surveillance over the system. We might tweak the OFR law a little bit to make sure that it's not a statistical agency. They ought to be doing oversight of the system. But if the Federal Reserve issued a regulation that some others thought was outrageous, in order to be reviewed, they could send it to FSOC, and just the exact authority of FSOC has to be determined, but they could send it back at least to the Federal Reserve and say, rethink this.
For consideration.
Yeah.
So, do we have one more time for one more question? Do we have a question all the way over here, I believe? Yes.
Hi, Mr. Chairman. Ryan Tracy with the Wall Street Journal. When former regulators talk about this idea of revamping and consolidating the financial oversight system, they always think it's a great idea, but you never hear a current regulator say that. I always noticed that distinction, and I wonder what do you think, how and you also talked about the political implications of response to your plan, and we heard a little bit about that from Barney Frank at lunch as well. How will you pitch this plan to current regulators and to Congress? And what response have you gotten so far?
I think I know what the question is, but maybe...
So essentially, he said he hasn't met many current regulators who think that the system should be consolidated. But
No, absolutely.
How will you persuade current regulators, and particularly Congress, to make these
Well,
changes?
you're going to have to persuade the Congress. That's right. All these regulators understand it's not a very good system, but they're all worried about don't raise the question because we don't want to be affected adversely. And it's all fine so far as we're concerned. And that's inevitable. I didn't worry much about that when I was in the Federal Reserve because I always thought the Federal Reserve would emerge on top anyway, so you didn't have to worry about it. But I think you can get over that. And the main thing that people talk about, and everybody does, bringing the supervision together. And the OCC won't like that because you see what happens to the OCC, and the Federal Reserve may or may not like it, and the FDIC may object, but they're all going to be on the board of this new organization, and they may find it more satisfying in the end than what they got now. It's just that what's different now is a need. It's always been evident, but now it's been displayed in its full glory. And if we can't do something...
better coordination is really what you're saying.
Yeah,
Better coordination of policy.
you're not going to get better coordination without doing some unification. So I think there ought to be an opportunity now. Now, maybe the fact is nothing can get through the Congress of any substance. But if they wanted to put something through that doesn't raise, I don't think the Tea Party people have great feelings about this, or the other people. They have feelings about extraneous issues like auditing the Federal Reserve when it's already audited, and what they mean by that, and tinkering with the Federal Reserve banks or whatever, or giving rules to the Federal Reserve. It's not going to happen anyway, but I don't think. But that's all beyond the point. They ought to sit down and talk about substance, which they could have done in Dodd-Frank. I mean, they could have theoretically, but I think it overloaded the
how much the wagon could carry.
Yeah, exactly. And so they did something which made sense, but it certainly needs tinkering. The FSOC and the OFR, in my opinion. Because it's funny, an initiative that makes conceptual sense has made everybody unhappy, the way it's actually done in practice. But I think with some tinkering, it could be.
Well, Chairman Volcker, we want to thank you for coming to our conference. At GW, we're particularly grateful because you helped us establish scholarships in your name for people to go into public service.
Oh my God!
And financial regulation. So we're trying to carry out Princeton's motto, so to speak, at GW.
Well,
we are very grateful.
That's a good idea.
Coming once again, and
if they get one of those scholarships, they've got to be in favor of reform.
yes. Just we tell them they can't become lobbyists.